Hectic shopping, meeting friends and family, binging on delicious food, and of course lighting up your homes. That's the super fun part of Diwali. I'm sure most of you have your calendars packed. But we want you to pause a bit and also remind yourselves Diwali is all about inviting Lakshmi to your homes. It's an invitation to prosperity. So here we are, hoping to give you a good macro picture on all the investments you can look at and make money on. Today on this special, what do we bring you? We'll talk about equities and stocks, everybody's favorite, the outlook on Indian stock market with a well-respected, well-known market expert, Nikhil Vora, Managing Director, IDFC Securities. Nikhil, thanks very much for being here with us. Also on our panel to thrash out equities and another much-loved asset class by us Indians, that's the glittering gold, is Gagan Randev, CEO of Religare Securities. Gagan, always a pleasure to have you.
Thank you. Always a pleasure.
And 50% of most family savings in India go into real estate or property. That's something we just can't ignore, especially around Diwali. So if you're looking to buy your first home or to invest some more in property, stay glued to the television. Opinion that you may have to pay the top dollars for will come to you for free from India's leading real estate experts, Ramesh Nair, MD Jones, Lang LaSalle, and of course, India's best real estate intelligence unit, Prop Equity. CEO and founder Sameer Jasuja is with us. Gentlemen, Ramesh and Sameer, thanks very much for joining in. We have a very young audience. Let me start by wishing them a very, very prosperous and happy Diwali. And of course, let's get cracking with the first question because all of them have many questions on lots of asset classes. Pulkit Chokhani wants to know something about stocks. Go ahead, Pulkit.
Hello, sir. We see so much of volatility in the Indian stock markets. Also, like the Indian indices have been one of the worst performers of the out of all the emerging economies. The returns in Sensex have been like negative 17%. So many stocks are quoting in their 52-week lows. So what advice would you give to us fresh new retail investors? When do we actually enter the market? Is this the right time? Should we hold some more? Or, I mean, what's your take on that?
Nikhil, is it the right time to get into stocks? He's very upset about the 17% loss and the fact that Indian markets have bled the most over the last 1 year. What's your take?
You know, it's interesting. Let me start with a quote of Marilyn Monroe. You know, she said that I'm selfish, uncontrollable at times, but if you can't handle me at my worst, you'll never get me at my best. You know, there is obviously no doing to say that clearly global markets are in a standstill mode across the world. You know, you're looking at US, Europe, Japan, China now incrementally get into a significant pain point than what we've seen historically. But you know, it's very strange when we look at India right now. You know, all of us are troubled explaining why 7.5% GDP growth is not really a great growth. But look at global markets and stuff, you're actually looking at growth falling apart by 50 to 70% in most of the geographies. And while I'm no expert at predicting what happens in those geographies, but one thing which is very certain is that I think the pain point in those markets will last a lot longer than what all of us are envisaging. Now in that context, when global markets are falling apart from their earlier projected growth of 50-70%, Indian growth at worst will be down by around 10 to 12%. So clearly growth is still, in a reasonable sense, still pretty much there in India. And if you look at value, for once, you know, close to around 35 to 40% of Indian markets are right now at a EV to capital employed of less than 1. And to put it in a very layman term, it basically means that today all of us have the ability to put in money at par with Indian promoters. And I think that's a big statement to really look at because, you know, fundamentally a lot of these businesses have existed for more than 10, 20, 30 years and have done a return on capital which is over cost of capital. So in a very placid way, you know, there is a fair bit of reason to believe that you should be valued at more than 1.5 times invested cap. So there is a fair bit of market potential per se that one should look at. Having said that, you know, I also think that, you know, for retail investors, you know, you can't really be investing in the herd. There are values that one will need to evolve into. There is a time horizon which, frankly, needs to be kept in track. And I understand that this has been oft stated that, you know, in long term you make a lot of money. But the fact is the way the markets are globally right now, it seems that you'll make money only in the long term. So, you know, if you're willing to play that out, then I think there's still a lot of merit and there are a lot of businesses which one can possibly bite into. If not, the option trade is still fairly lucrative for retail investors, which is to really put in money in debt at 10% plus. So if you're willing to take a year call plus, I think there's still a lot of value in the market.
Is year plus call enough, Nikhil? That's another thing, because when you talk about long-term equity, you generally talk about 5-year plus. But if let's say 2 to 3 years is the horizon, is equities the way to go?
It's very interesting, and I think there's some sharing that I would like to do. In every bear market, which is the case right now in India, all of us, in retrospect, have 5 reasons why the market went bearish. The reasons right now could be that interest rates are high, inflation is high, government inaction has been of a disordinately high level, earnings growth will come off, global uncertainties are large, and so on. My sense is, and whatever limited market one has seen in the last 20 years, is that markets don't reverse because those issues get addressed. Fundamentally, all the negative issues that one believes has been the reason why markets have crapped out, they never get addressed on their way up. Markets get into a fatigue mode, they form a trough, and post that maybe a couple of those issues get sorted out. So if today we are looking at government inaction as a big issue, and maybe there are 14 to 15 policy actions which are expected out, my sense is that possibly 2 or 3 will actually see the light of the day. The balance will not even move into any gravitational force, so it will not even go forward. But those 2 or 3 are good enough for markets to take a directional call. It takes its own time. Today, so my sense is that, like 6 months back, all of us were grappling with suggesting that, if crude came off, the markets will be perfectly all right. Crude has come off, markets are still where they are. So crude has become a relegated item, literally. So my sense is that, every bear market reversals don't happen because of the issues that the bear market started off with. It happens for issues which are totally disconnected at some stage. So I'm not so bearish on the way the markets are today. I think it's tough to find really great quality stocks right now. Maybe a lot of businesses will require the time period which is required to really make disproportionate capital out of it. But, I can't forget Marilyn Monroe right now. So I think you've got to really handle
You've got to stick with me through thick and thin and take all my moves, because I will be very pleasing to you in the long run. Gagan, come in here. 50, he's talked about another important point. Many stocks are at their 52-week lows, but this is not true of the entire universe of stocks out there. Many have actually moved up higher than what they were even in the last bull run. There could be just a handful. So the ones languishing are the ones that we just haven't had the appetite for. Real estate stocks are one big pie out of that.
Absolutely. I think, and I'd just like to clarify today, the fact is you're right that there are a couple of stocks out there which are typically at their, 52-week high, etc. But the majority of stocks, and when you look at some of the stocks and some of the valuations that they're available for, they're really cheap. But again, the perspective is what is the time frame with which you're looking at a stock. I would say, I totally echo what Nikhil said. I think we are staring at a problem which is not going to go away, very soon. In the last 20 years, the West has really been induced in a credit crunch. You've had a situation where the economies, individuals have lived with easy access to credit, where real incomes have been falling, but thanks to credit available at 0.1%, you've lived lavish lifestyles beyond your means. You have an aging population in Europe, you have an aging population in the US, who have been promised very high social benefits, and the fiscal positions in these countries are such that all this is challenged. So you are looking at a situation in the West where for the next 4 or 5 years you don't see any of these problems going away. So as I look at things today, I see a situation where for the next couple of years you have the entire West which is probably going to grow at 0 to 1%, and you have 50% of the world, which is Asia and the other emerging markets, which are probably going to grow in the region of 5 to 7%. While in the last 2 years, if you look at the share of exports from emerging markets, that has greatly been reducing its dependence on exports to the West. The fact of the matter is that is still high. So if you have a prolonged bearish, spell, which carries on in the West, you are going to have issues in the short term. However, having said that, typically, when issues break out, and I think we've had this psychosis of fear for the last year, etc., where people have been hesitant, have been afraid of what's going on. So if you look at Indian markets also today, HNIs and retail are underinvested in equities in India this year like they haven't been in the last 10 years. So the amount of participation in equity markets is actually at its 10-year low. So which gives us a lot of comfort, because where there isn't a lot of participation, there is not going to be a lot of unwinding. Yes, there could be a little bit of unwinding which happens from FIIs, etc. But if we take a slightly longer term view, the same reasons which are going to cause money to go away back to, the US dollar, if that is taken as a safe haven, you want to take money out, they are going to be the same reasons why eventually money is going to start coming back into other growth opportunities. And the way I look at it, in the next couple of years, the growth opportunities for me, and in no particular order, are going to be basically one, corporate debt, as Nikhil said, looks very good at this point of time. It's going to look very good for
the ignoring bank FDs and corporate fixed deposits.
Equities are looking good in India from a 3-year perspective, so you need to be ready to I can go in, typically we can say take a 1-year view, but if necessary, extend that to 3 years. And the third thing is gold. With all the turbulence, and no matter what everybody may say that gold is ready to correct, etc., when I look at the real price of inflation-adjusted gold, if you would take the price of inflation-adjusted gold, it used to be $850 to the ounce in 1980. By that logic, you should have been at a price of $2,400 today. You are at a price of $1,650. I see gold continuing to, and while there's a short-term resistance at 1,680 to 1,700, so there could be a small correction there.
Right.
But the long-term growth story for gold remains intact. So if I were an investing man, which, typically when I look at this audience here, and if I take a typical 35, 40-year-old in India, I would say over the course of the next year, invest a third in gold, invest a third into equities, and within equities, equities like for me, a lot of MNC stocks, where they probably hold over 50%, make a lot of compelling. Why? Because I see a lot of companies, MNCs, coming into India and delisting their companies. And I'll give you a reason for that. You have MNCs where they are looking at cost of capital in their respective markets of 0 to 1%. They're sitting on cash. They are not investing back in their economies because there is no faith in the economy. I see with that access, and when you have a growth market in India where typically you would expect a company to grow at 15 to 20%, there is going to be a lot of buyback. So companies like Bayer, Oracle, all these are compelling investment opportunities from a long term, because there could be a buyback which happens in the stock any point of time. So these, along with debt, are the way I would split my money.
Nikhil, Gagan's quite positive on MNCs. He's saying look at that basket very closely, because there's a possibility that group of stocks may look at delisting in the future, and that could actually be very rewarding for the investors. What about you? What are some of the stocks that you would keep a very close eye on, or go out and put money this Diwali?
It really depends on what sort of a mind frame you are in. Your time period, as also your expectations of returns across the board. So if I was an institutional investor, I would obviously be slightly more aligned to the larger tier companies and so on. I might be also a better guy if I did my hedges on these stocks. So I might be bullish on Tata Motors for the next 1 year, and maybe play a bearish call on Maruti. So if I had to play a trade, I would play a long Tata Motors, short Maruti, and that might be a trade which I am willing to live with for the next year or two. Similarly, if I had to play a trade on financials, I would be long, say, IndusInd Bank and maybe ICICI Bank and HDFC, and short the entire PSU sector banks. So I might be bullish on the financials for a longer term, but I also believe that the pain in the system might last a lot longer. And the fact is that if today maybe close to around 8 to 9% of corporate India is coming up for restructuring or reschedulement of debt, then theoretically you could go long infra and short bank. So you've got to play your strategy on what you want to do. Third is, if I was a retail investor, then possibly I want to buy beta. I want to buy beta, and I want to buy growth which could be disproportionate. So I'm no longer building in a 20% compound into stocks which I might want to own as an institutional investor, but as a retail investor, maybe a 20% compound still may not make too much of sense. And I also believe that Indian retail investors actually have a lot more cushion now than what they've ever had earlier. You've never had a situation where their largest hoarding, which could be gold, or which could be property, which could be debt, which is savings. All of them are at all-time highs.
Right.
So whereas equity, which is the lowest investment component for them, is possibly at mid lows of stuff. So I think the risk appetite for individuals should be at a very high level. And if I have to look at that, then maybe I would buy businesses like maybe a Hitachi Home, a small name in consumer durables, but I think could become very large in the next 3-4 years. Maybe I would want to buy a education business, and which I understand is smeared by a lot of corporate governance issues right now, but maybe an Educom today might make a lot more sense. Maybe buy a paints company, which I think is a durables business, so maybe an AkzoNobel. Maybe look at some of these guys, and my gut is that you could make a slight more disproportionate return in these businesses than a lot of other businesses. So if I want to go into slightly more secure zone, I would possibly play a hedge trade, which is play long telco, short Maruti, long private sector,
right.
Short public sector banks and so on.
No.
And I could play a naked long on some of the mid caps.
A little bit more debate on gold. There are differing opinions. Gagan believes that 1/3 money could go into gold. But does Nikhil and other analysts also feel the same way? Keep watching Let's Talk Money. This is the Diwali special and we are telling you, where should your money be going? All that's glittered in the year gone by is gold. Global uncertainty made investors rush for a gold cover, and this yellow metal we all love, especially Indians, ended up giving investors a whopping 33% returns in the last 12 months. 20% plus if you look at just 6 months gone by, and take longer periods, 5 and 10 years, and you wonder, shouldn't you have put all your money in gold alone and forgotten about every other asset class? Returns have been a secular 20% plus. Gagan Randev, CEO of Religare Securities, says that 1/3 of your money should be in gold. But I do know there are different views. Let me bring in Nikhil Vora, Managing Director of IDFC. Nikhil, no gold, right? Or very little gold in the portfolio?
I'm saying by default, Indians have more than 1/3 of their asset locked into gold by default. Would I want to buy gold at current prices to ensure diversification further for my incremental capital that I make? I'm saying that right now, I haven't seen gold prices go up by 54% in the last 1.5 year odd, and that is fundamentally a non-productive asset class. So I would love to be proven wrong on the sustainability of gold prices from here as a return instrument. And if I'm taking it as a return or a ROI business from here on, I would think that a debt or an equity might make a lot more sense. I think the uncertainties that one is looking at right now is by default forcing gold becoming a safe haven, but that's an event call, and event calls don't last for perennial. So I would be extremely skeptical to put in money in gold right now.
Skeptical about putting money in gold because all our families already have a large holding on gold. But it's still a matter of debate on where the prices of gold are headed. Rohit Mittal.
Good afternoon, sir. Given the recent increase in the gold prices, should the retail investor actually look at investing in gold, maybe through the physical gold or ETFs, maybe?
One fundamental, point, and I think when we talk about investing in gold, the premise is, and when I say 1/3 of allocation into gold, the premise is you're already not sitting on 50% of gold in the form of jewelry. It means when you look at your total allocable surpluses, 1/3 of that for the next couple of years goes into gold. See, I think the reason I make my, the premise that I made on gold is for a couple of reasons, and which I surmised earlier. We don't see global uncertainty, etc., disappearing for the next couple of years. When you think about fundamentally, these are economies which are going to go into a recession. You have negative starts happening from, be it from housing to production, etc. Can the economy, can the currency of these countries actually hope to sustain? Over the course of the 6-9 months, as people realize that keeping money in US treasuries, which are going to give me 0 to 1% kind of return, is not what we are looking for, money is going to start emerging into other asset classes. What are the other asset classes? Emerging markets, where we say you're going to start getting allocation into equity. Into gold. Why gold? Because gold, unlike anything, there is no risk of default in gold. So it becomes, by natural choice, a safe haven for investments, because there is no chance of default on gold. And I again made the point, and I'll go back and reiterate the point. If you actually look at the price of gold, which was $850 in 1980,
there's been a secular bull run.
What you call it's still, even at inflation, the price should have been about $2,400. So it's not overvalued by any.
Is that where you think gold prices are going to go?
See, our personal belief as a house is that, and which is what a lot of commodity experts in the world talk about, that you can safely assume a 20% rise for gold in the next 12 months, and probably an even higher rise in the next couple of years. So if I were a betting man, which which I'm normally not, but I would say definitely that you should see from these levels, and there could be a short-term correction, but you can safely assume a 15-20% kind of rise in the price of gold over the course of the next 12-15 months.
The traditional philosophy on investing says you should have at least 5 to 10% gold in your portfolio, but of course, as Gagan's been saying, you can actually go up higher and look at 25 to 30%. Many people talking about that fact, and that's the reason why excitement in gold is quite evident if you see what's happening in gold ETFs or exchange traded funds. Remember, that is something we do recommend, that you must buy gold only in the ETF form. Physical gold is tougher to maintain and tougher to store. 6 months data, April to September 2011, there was such a gold rush that on National Stock Exchange or NSE, where most of the gold funds are traded, saw an average daily value increase of 400%. Average daily trades increased by 300%, and people have been investing in exchange traded funds. So you should also look at that. If you look at the assets under management of gold funds, they have more than doubled or increased by over 100%. Now, why are they ideal for retail investors? Number one, they offer a huge amount of purity, 99.5%. You go to a gold, or if you go to a jeweler, you don't know what are you getting. Even with a certificate, I think 99.5% is tough to maintain. Investor can invest in very, very small amounts, and physical delivery is possible for units equivalent to a kg of gold and above. And apart from being a good hedge against inflation, we've already talked about it, ETFs are actually very flexible to the buyer. You can buy anytime, you can sell anytime, buy a small unit. You can actually buy gold ETF for about 1,000 rupees a month. You don't even have to go up higher than that. But most importantly, no storage hassles. Where are you going to store gold? There's always a fear in your mind. And the tax benefits. ETFs clearly emerge over other options of buying physical gold, because if you have assets of more than 30 lakhs, including gold, you have to pay 1% wealth tax. On the other hand, if you buy gold ETFs, there is no wealth tax. Additionally, physical gold, an investor has to pay 1% VAT, and there is no VAT on gold ETFs. There's no sales or securities tax as well, securities transaction tax after that. Nikhil, thanks very much for joining in. It's been a pleasure to have you with us here. No easy answers on the debate of gold, but yes, everybody believes that if you look at jewelry within your portfolio and then go out and buy some more gold ETFs, 10 to 20% is something that should be there as a hedge against all the uncertainties. Equities, the verdict is, will outperform gold, and probably always buy into something which is productive. A company is making profits, is growing a business, while gold is an unproductive asset. Now, something that we still need to discuss, which we will next week, property, an important integral part of everybody's life, a home to buy in or just property to invest in. Come back to us next week. We will continue this discussion and this debate. If you're chasing your dream home, we'll tell you how to get the best deal from the builder, or just looking at investing in a piece of real estate. Where should it be? Should it be commercial or should it be residential? Ramesh Nair, Sameer Jasuja and Gagan Randev will join us back next week. Till then, goodbye, and I'll see you again. Light up your homes really beautifully.